Should I invest in mutual funds or the stock market? Which is better and which is safer?
Want to know the answer to these questions? Well, watch this video till the end to find out the difference between mutual funds and stock market. Hi everyone, I am Prarthana from Clear. We are India's largest tax and financial services platform where we have served more than 6 million tax filers so far. Subscribe to our channel to get investing tips and learn more about growing your money. A mutual fund is set up as a trust and established by a sponsor. The asset management company AMC pools money from individuals and institutional investors with common investment objectives. The best thing about mutual funds is that the fund manager professionally manages the pooled investment by investing in financial instruments based on fund objectives. When you invest in equity mutual funds, you get returns through dividends and capital appreciation over time. What's more is that you can also choose to invest in mutual funds either through a systematic investment plan or SIP or by paying a lump sum amount. With a SIP, you can start investments with an amount as low as Rs 500 per installment. Moreover, it encourages disciplined investment to reach your financial goals. A stock market is an online platform where shares of companies are listed and then bought and sold by the participants, that is, the buyers and the sellers of shares. The participants can be investors or traders who seek profits over a short period of time. When you invest in stocks of a company, you may benefit from the capital appreciation of the stock over time. Stock traders, however, look for quick profits by focusing on small price changes in the equity shares. In India, the Bombay Stock Exchange or BSE and National Stock Exchange or NSE are the major stock exchanges where stock trading takes place. You need to place the order on these stock exchanges through brokers registered with SEBI who offer online stock trading services. Stock buyers and sellers enter their trades through the trading terminals of their stockbrokers. These orders are transmitted to the entire trading network of the stock exchange. The system electronically matches buy and sell orders. Buy orders with a higher price are matched first and sell orders with a lower price gets priority. Orders at the same price are prioritized based on the time when orders were entered in the system. Buyers of shares must provide funds for their purchase and sellers must deliver the shares they have sold. This is the pay-in process completed within a specified time. After the pay-in process, you have the payout process where the buyer receives the shares and the seller gets the funds or money for the shares sold. The process of exchange of funds and shares is called a settlement. The clearing corporation functions as a counterparty which is buyer to a seller and seller to a buyer for all trades and settles them without default. To provide this guarantee, the clearing corporation collects adequate margin from all members so that traders are settled without any default. Is the stock market in India making sense? If it is, write clear in the comment section below. So now let's look at the difference between mutual funds and stock market.
Equity diversified mutual funds spread your investment across sectors and industries to reduce volatility in investments. With stocks, there's little scope for diversification. The research team picks appropriate stocks for equity funds and a professional fund manager manages your investment. With stocks, you have to pick them yourself. Equity mutual funds are suitable for the first-time stock investments. However, investing directly in stocks requires knowledge and time. The research team and fund manager pick stocks and manage the investment with equity mutual funds. With stocks, you have to manage investments yourself. Equity diversified mutual funds reduce risk by diversifying the portfolio across sectors and industries. In stocks, the performance of one stock cannot compensate for another. Tax-saving mutual funds called Equity Linked Savings Scheme or ELSS are eligible for a tax deduction for up to Rs 1.5 lakh maximum per annum under Section 80C. However, there is no such tax benefits if you invest in stocks. You can get a diversified portfolio in equity mutual funds that are managed by mutual fund managers. However, there is no such diversification possible in stock investments. You don't have to control over which stocks are picked and for what duration in equity funds, as the fund manager does it. You make the buy and sell decisions yourself in case of stocks. The fund manager manages your investment and the research team picks the right stocks, saving your time, whereas you need to spend time on research when you invest in stocks.
So folks, I hope you understood the difference between mutual funds and stock market. You can start your mutual fund investment journey by downloading the Black app by ClearTax from the link given in the description box below. Well, download the Black app as it will help you grow your wealth and invest wisely. You won't regret it. Also, don't forget to subscribe to our channel for more finance related content. Thank you so much for watching the video. Stay tuned for the next video and take care.